right. So are you ready to like dive into Warren Buffett's brain?
Always up for a challenge.
Right. It's like we get to peek behind the curtain today.
I love it.
We're going to try to decode his 2025 investing strategy.
Yeah.
You send over this Motley Fool article.
Uh-huh.
It's from January 7th, 2025.
Okay.
It breaks down like some of his recent moves and what they might signal for the market.
Right.
Think of us as your financial detectives.
Okay. I like that.
We're going to sift through the evidence,
Yeah.
see what clues we can uncover.
Yeah.
And what makes this so interesting
Yeah.
is we're not just talking about like theoretical advice here.
No.
We're looking at what Buffett is actually doing with his billions.
Right. Exactly. His actual move.
That's got to be like a good starting point. Right?
Oh, absolutely. Actions always speak louder than words.
Especially when you're talking about someone like Warren Buffett.
Especially him.
And the first thing that jumps out from this article
Yeah.
is that massive cash pile he's sitting on.
Right.
Over $300 billion.
For Berkshire Hathaway.
Berkshire Hathaway.
Yeah. The highest percentage of their assets in cash in over 30 years.
That's crazy.
It's significant.
Got to mean something, right?
It definitely sends a signal.
Yeah.
I mean, think about it.
It's Warren Buffett.
He's famous for being a long-term value investor.
Right.
He's not one to shy away from the market.
So for him to be holding on to this much cash.
It suggests he's seeing something different.
Oh.
He's either anticipating a market correction,
Uh-huh.
or maybe he's just being extra cautious
Yeah.
in a market that many consider to be overvalued. I mean, there's a lot of talk about a potential bubble.
Especially after the tech sector went crazy last year.
Exactly.
Yeah.
Yeah, that's a factor.
But it's one thing to like hear those rumors
Right.
and another to see someone like Buffett actually making moves based on that.
Absolutely. Putting his money where his mouth is.
So he's holding cash.
Yeah.
What else is he doing that might give us some insight?
Well, the article points out that he's actually been a net seller of stocks
Yeah.
for the past several quarters.
So he's been selling more than he's buying.
More than he's buying.
That's interesting.
Which is interesting.
Because typically you'd expect to see investors buying more when the market is doing well.
You would think so.
It's counterintuitive.
It is a bit.
So even though the S&P 500 soared last year, he's pulling back.
It seems that way.
It's like he's seeing something the rest of the market isn't.
Yeah, it's making people wonder.
Are we missing something?
It's possible.
Okay.
This could be a sign of caution.
Mm-hmm.
He might be anticipating a shift in the market,
Okay.
or simply finding fewer opportunities that meet his very strict value investing criteria.
Oh, right. Because he's always looking for those undervalued gems.
Exactly.
Companies with solid fundamentals that are poised for long-term growth.
That's his bread and butter.
So is he just not finding those gems right now? Is that why he's holding back?
That's a possible interpretation. Yeah, it seems that way.
Okay.
And what's even more telling is that he's actually decreased his positions
Oh, wow.
in some of his longtime favorite companies
Right,
like
unbelievable.
Apple.
Wait, Apple. He's trimming his stake in Apple.
That's what the article says.
That's a big deal.
It is. It's gotten people talking.
It seems like every investor on the planet is like bullish on Apple.
Yeah, they're a powerhouse.
So why would he pull back from one of the seemingly strongest companies out there?
That's the million-dollar question. It raises a really important question
Yeah.
about his view on even the most seemingly invincible companies.
Okay.
It could be that he believes their current valuations are too high.
Interesting.
Or maybe he's seeing a shift in the tech landscape that's making him rethink his position.
I see.
We can't know for sure,
Right.
but whatever the reason, it's a reminder
Yeah.
that even the Oracle of Omaha isn't afraid to make changes
Right.
based on his assessment of the market.
That's a great point.
Yeah.
It's easy to get caught up in the hype, especially when it comes to tech stock.
Oh, absolutely.
But Buffett's moves remind us
Yeah.
that we need to stay vigilant,
Right.
do our own research,
Always.
and not be afraid to make adjustments
Yep.
based on our own analysis.
Exactly. You can't just blindly follow the crowd.
Okay, so let's recap.
Sure.
He's holding cash,
Uh-huh.
he's selling stock,
Right.
and he's trimming his positions in longtime favorites.
Yes.
What's the takeaway here?
Well,
Is he bearish on the market overall?
I wouldn't say bearish,
Okay.
but he's definitely more cautious than he's been in the past.
That's something we need to pay attention to.
It is. It's a valuable data point.
So how do we translate Buffett's caution into an actionable strategy?
Yeah. That's the key question.
For someone like you who's listening,
Right.
how could we apply these insights to our own investment decisions in 2025?
That's a great question, and that's exactly what we're going to unpack next.
Perfect.
We'll look at the specific strategies the Motley Fool article suggests
Okay.
based on Buffett's moves,
Uh-huh.
That could help you navigate the market this year.
Sounds good. Okay, so we've established that Warren Buffett is sending some like cautious signals
Right.
with his recent moves.
Yeah.
But he's not completely out of the market, is he?
No, not at all.
The article you sent mentions he's still making some strategic investments.
He is.
So what's the secret sauce?
Right.
How can we like follow his lead
Yeah.
without needing billions of dollars at our disposal?
That's the million-dollar question, isn't it?
It is.
And the Motley Fool article actually lays out a few key takeaways
Okay.
from Buffett's playbook that we can all learn from.
All right, let's hear it.
First and foremost,
Yeah.
value, value, value.
Oh, yeah. He's all about that.
Even in a potentially overpriced market,
Right.
there are still hidden gems out there.
Okay.
It just takes a bit more digging to find them.
That makes sense.
Yeah,
It's easy to get swept up in the hype
it is.
and chase those high-flying stocks.
Oh, yeah, those flashy ones.
But Buffett has always been about finding those undervalued companies with solid fundamentals.
Yep, companies that are built to last.
So how do we apply that to our own portfolios?
Right.
Are we talking about like digging through financial statements and doing all sorts of complicated analysis?
Well, some analysis is definitely helpful,
Okay.
but it doesn't have to be overly complicated.
I like to hear that.
The article highlights meta platforms
Right.
as a prime example.
Really? I thought they were kind of out of favor.
They are.
After all, the metaverse stuff didn't really take off.
Exactly.
That's okay.
Expected. And that's why it might be undervalued right now.
Oh, interesting.
Sometimes those companies that have fallen out of favor can present great opportunities.
Okay.
It's all about assessing their long-term potential
Yeah.
and not getting caught up in the short-term noise.
So we're looking for those companies that have solid fundamentals,
Right.
but maybe aren't the hottest thing on the market right now.
Exactly. They might be flying under the radar.
What about those companies that are like struggling, but have the potential to bounce back?
That's another area where Buffett has found success.
Okay.
Think of companies like Pfizer.
Okay, yeah.
They haven't had the best run lately, but they have a solid foundation and a history of innovation.
Right. They've been around forever.
They could be setting themselves up for a major comeback.
It's like finding those diamonds in the rough.
I like that analogy.
And it's a good reminder that investing is all about looking ahead,
Yes.
not just focusing on past performance.
The future is what matters.
But let's be honest,
Sure.
it's tempting to put all your eggs in one basket
It is.
when you see a sector booming.
Especially with all the excitement around AI lately.
Right.
Yeah, everyone's talking about it.
Is that something Buffett is doing?
Not really.
Jumping on the hottest trends?
While he's certainly not ignoring the potential of AI,
Mm-hmm.
his approach has always been about diversification.
Okay.
So don't put all your eggs in one basket.
Don't put all your eggs in one basket.
No matter how promising that basket might seem.
That's the don't put all your eggs in one basket advice my grandmother used to give me.
Classic wisdom for a reason.
It's true.
Spread your investments across industries
Okay, so spread it out.
to protect your portfolio from fluctuations in any single sector.
Makes sense.
You don't want to be overexposed to any one area.
So we're looking for value.
Yeah.
We're diversifying.
Uh-huh.
What else can we learn from Buffett's approach?
Patience.
Oh, pay.
This is a big one.
Yeah.
Remember that famous Buffett quote?
Which one?
If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes.
Yeah.
He's all about long-term thinking.
He is.
Find companies you believe in for the long haul
Right.
and ride out the inevitable ups and downs of the market.
That's easier said than done, though, right?
It is. It takes discipline.
Especially when you see your portfolio dipping.
Yeah, it can be nerve-wracking.
But his long-term holding of Coca-Cola is a great example
It is.
of how that patience can pay off.
Absolutely. He's held onto that stock for decades
Yeah. Wow.
through multiple market cycles.
That's commitment.
It's a testament to his belief in the power of long-term investing
Yeah.
and focusing on companies with enduring value.
Okay, so we've got value, diversification,
Yep,
and patience.
the trifecta.
That's a pretty solid foundation for any investment strategy.
It is. It's a good starting point.
But there's one more thing the article mentioned
Okay.
that I want to unpack.
Sure.
It talked about the S&P 500 Shiller KP ratio,
Right.
which sounded a bit intimidating.
It can be a mouthful.
Can you break that down for us?
Sure. The KPE ratio.
Okay.
or cyclically adjusted price-to-earnings ratio, is basically a way to measure whether the stock market is overvalued or undervalued.
Okay.
It looks at stock prices relative to their earnings.
So like how much you're paying for a dollar of earnings.
Exactly.
Okay.
But it looks at it over a long period, usually 10 years.
Also, it's not just like a snapshot.
No, it's a broader view.
Okay.
And it adjusts for inflation.
So it takes into account the changing value of money.
Right.
Okay, I'm following.
So it gives you a broader historical context for market valuations.
So it's not just looking at today's prices,
No.
but how they compare to the past.
Exactly.
That seems like a pretty useful tool.
It can be.
What does the Chippy ratio tell us about the current market?
Well, according to the article,
Yeah.
the Shiller-Chippy ratio is currently quite high,
Oh, that doesn't sound good.
which historically has been a signal
Okay.
of a potentially overvalued market.
So maybe that's another factor influencing Buffett's cautious approach.
It's possible.
So if the Chippy ratio is high,
Yeah.
does that mean we should all be selling our stocks and like hiding our money under the mattress?
Not necessarily.
Okay, good.
Remember, the KT ratio is just one indicator,
Right.
and it's not a perfect predictor of future market movements.
So it's not like a crystal ball.
No, it's more like a compass.
Okay.
It can give you some direction. But it's definitely something to be aware of.
Yeah.
It can give you some perspective
Yeah.
on whether the market is expensive or cheap
Mm-hmm.
relative to its historical average.
It's like a warning light on your car dashboard.
I like that analogy.
It doesn't necessarily mean you need to pull over immediately,
Right.
but it's definitely something you should pay attention to.
Exactly. You want to be informed.
So how do we use this information to our advantage?
Well, if you're concerned about a potential market correction,
Okay.
you might want to be more selective with your investments.
Yeah.
Focus on those undervalued companies we talked about and consider diversifying into other asset classes
Okay.
that might be less correlated with the stock market, like bonds or real estate.
So not putting all your eggs in one basket.
Exactly. Spreading the risk.
That makes sense.
That's all about managing risk
Yeah.
and not putting all your eggs in one basket.
But even with all this talk of caution,
Right.
it's important to remember that Buffett is still investing right. He's just being very strategic about it.
Exactly. He's not sitting on the sidelines completely.
He's still in the game.
He's still finding opportunities, like those investments he made in Domino's Pizza and Pool Corp last year.
Oh, yeah. I remember reading about that.
It shows that even in a market that some consider overvalued,
Yeah.
there are still deals to be found if you know where to look.
That's encouraging.
It is. It means there's still hope for us mere mortals.
So what's the key takeaway here?
I think the biggest lesson is that even in a potentially volatile market, there are smart ways to position yourself for success.
Okay.
You don't have to be a billionaire to follow Buffett's principles.
That's good to know.
It's about understanding his mindset,
Yeah.
his approach to risk,
Mm.
and his long-term vision.
It's about being strategic, not reactive.
Well said.
Doing your research.
Yes.
Being patient.
Absolutely.
And not getting caught up in the hype.
Exactly. Keep a cool head.
And remember, investing is a journey,
Is.
not a destination.
Well said. There will be ups and downs along the way.
That's for sure.
But by sticking to these fundamental principles,
Mm-hmm.
you can increase your chances of reaching your financial goals.
I like that.
Now, speaking of journeys,
Okay.
the Motley Fool article only gave us a snapshot of the KPE ratio.
It did feel like we only scratched the surface.
It might be worth exploring that further.
You're right. It did feel like we only scratched the surface with the KP ratio.
Yeah, it's a fascinating metric.
It's one thing to know it's high, but what does that really tell us about what we should be doing?
Right, good question.
Like, how do we actually use this information?
Well, what if we, put on our historian hats for a minute
Okay.
and take a deeper dive into the past?
I like where this is going.
Imagine looking at other periods in history when the KPE ratio was similarly elevated.
Okay.
What happened next?
Right. Like, did the market correct itself?
Exactly.
Or did certain sectors outperform others?
Maybe Buffett changed his strategy.
Oh, yeah. Did he, completely shift gears?
We could look at that. There's so much we could learn
Right.
from studying those historical patterns.
It's like we've uncovered this hidden treasure map,
I like that.
and now we need to go on an expedition to see what riches it leads to.
Yeah, financial adventure.
I love that idea.
It's exciting.
It's all about understanding the bigger picture
Yes,
and recognizing those recurring themes that can help us make more informed decisions.
exactly. History often rhymes.
It does.
And while past performance is never a guarantee of future results,
Right, of course.
it can offer valuable insights and help us navigate uncertainty.
So we're not just blindly following the CPE ratio.
No.
But we're using it as a compass
I like that.
to help us navigate the market.
It can give us some clues.
And who knows, maybe we'll uncover some surprising insights along the way.
You never know.
That can help us fine-tune our investment strategy.
Exactly. It's all about continuous learning.
This is what I love about deep dives.
Me too.
There's always something new to learn. And you don't have to be a professional analyst to do this research right.
No, not at all.
There are plenty of resources available online
There are.
that can help you explore historical market data
Yeah, a lot of it is free too.
and see how the KPE ratio has played out in different scenarios.
Exactly. It's all out there.
It's all about being curious, asking questions,
Always asking
and
questions.
connecting the dots.
That's what it's all about.
So as we wrap up our deep dive into Warren Buffett's world
Yeah.
and his potential playbook for 2025,
It's been an interesting journey.
what's the one thing you want our listener to walk away with?
I think the key message here is that even in a potentially volatile market, there are smart ways to position yourself for success.
Okay.
We can learn a lot from observing what successful investors like Warren Buffett are doing,
Right.
even if we don't have billions of dollars at our disposal.
Yeah, we can still learn from the greats.
Exactly.
It's about understanding the principles behind their decisions.
Yeah.
Yeah.
And adapting them to our own investment style and goals.
It's about being strategic,
Yes,
not reactive,
that's key.
doing our research,
Very clearly.
staying informed,
Yeah.
and focusing on the long game.
Well said. That's the key to success in the market.
Couldn't agree more.
Yeah.
And on that note,
Yeah.
we'll wrap up this deep dive.
It's been a pleasure.
Until next time,
Until then.
happy exploring and happy investing.